Assalamualaikum warahmatullahi wabarakatuh. My name is SYAHFIRA and I will talk about Farm Fresh Company. Farm Fresh is a Malaysian dairy fresh milk company under the Holstein Milk Company Sendirian Berhad. The factories for this well-known Farm Fresh brand are located in Pahang and Johor. Farm Fresh Milk Company has been built up for 30 years. The company offers a variety of fresh, flavored and cultured milk and yogurt drinks. As of the latest financial reports, Farm Fresh has a strong capital base with its shares actively traded on the stock exchange, reflecting its robust market presence and expansion plans. This report provides a comprehensive analysis of the company's liquidity and working capital management over the period from 2019 to 2023.
Hi, Assalamualaikum. My name is Sofiya. So we go through for the first financial ratio. The liquidity ratio is a financial indicator that assesses a company's capacity to meet its short-term obligation using its short-term asset. In other words, it assesses how easily a company can pay off its current liabilities using its most liquid asset. There are three commonly used liquidity ratio, which is the current ratio, quick ratio, and the last one is net working capital to sales ratio. As you can see the graph here, the current ratio measures a company's ability to pay off its short-term liabilities with its short-term asset. A higher ratio indicates better liquidity. The ratio significantly increased from 2021 to 2022, 0.79 to 3.61, indicating an improvement in the company's ability to cover its short-term liabilities. However, it slightly decreased in 2023, 3.01, but it still remained strong. The ratio in 2020 and 2019, 1.18 and 1.34, were much lower, suggesting that the company was less liquid during those years compared to 2022 and 2023. The current ratio is more stringent measure that the current ratio as it excluded inventory from current asset. The ratio followed a similar trend to the current ratio. It showed a substantial improvement from 2021 to 2022, 0.34 to 2.80, reflecting a much better liquidity position. The ratio decreased in 2023, 1.94, but remained healthy. In 2020 and 2019, 0.81 and 0.82, the company's ability to pay off its short-term liabilities without relying on inventory was much weaker. The net working capital to sales ratio measures how much net working capital is available relative to the sales generated. A positive ratio indicates that the company has enough working capital to support its sales. The ratio turned negative in 2021, negative 0.11, indicating that the companies might have been facing working capital challenges relative to its sales. However, the ratio improved in 2023 and 2022, 0.52 and 0.76, showing a strong recovery in the company's working capital position relative to its sales. The ratio on 2019 and 2020, 0.11 and 0.06, were much lower, indicating weaker working capital management compared to 2022 and 2023. The data show a significant improvement in the company's liquidity and working capital management from 2021 to 2022. Although there was a slight decrease in this ratio in 2023, the company maintained a strong position, especially compared to the year 2019 and 2020. The negative net working capital to sales ratio in 2021 stand out as a period of financial stress, but in subsequent years demonstrate a market recovery.
Assalamualaikum and hi, I will continue by presenting the second ratio, which is profitability ratio. Profitability ratio is a group of ratios that indicates the return on sales, total assets, and invested capital. Specifically, we compute the profit margin, return on asset, and return on equity. In 2019, the company demonstrated robust financial health with a profit margin of 15.39%, a return on asset of 10%, and a return on equity of 17.4%. These numbers reflect a well-managed operation, generating strong profitability, efficient use of assets, and excellent return for shareholders. In 2020, we saw a slight decline in the profit margin, dropping to 11.62%, and the return on assets fell to 8.53%. However, the return on equity improved to 80.61%. indicating that despite the operational challenges or increased costs, the company managed its capital effectively, delivering an even better shareholder returns. Next, by 2021, financial performance weakened further. The profit margin fell to 7.39%, while return on asset decreased to 5.82% and return on equity dropped to 15.44%. This could suggest rising competition, higher operating costs, or difficulties in maintaining operational efficiency, leading to a noticeable reduction in both profitability and asset utilization. In 2022, the company experienced a notable rebound. The profit margin surged to 15.92%, the highest during this period, and return on asset improved to 7.91%, signaling more efficient asset use. Although the return on equity declined to 13.18%, it remains relatively strong. This rebound could be attributed to strategic adjustment, cost management, or favorable market conditions. Unfortunately, in 2023, the company faced a significant downturn. The profit margin dropped to 7.95%, the return on asset decreased sharply to 4.71%, and the return on equity fell to 7.94%. These declines likely reflect increased competition, rising costs, or operational inefficiencies that negatively impact both profitability and returns for shareholders. In summary, while the company showed strong early performance and rebound in 2002, recent years have presented challenges in maintaining profitability, asset efficiency, and shareholders' return. Strategic adjustment may be needed to address this trend and regain momentum moving forward.
Assalamualaikum, I'm IKRARMINA. Today I will present an analysis of Farm Fresh Activity Radio from 2019 to 2023. I will focusing on inventory turnover, fixed asset turnover, total asset turnover, and the average collection period. The inventory turnover ratio decreased from 47 in 2019 to 38.72 in 2020, but it's rebound to 82.58 in 2020 before it's falling to 56.52 in 2023. Its reflection in national challenges and subsequent recovery in inventory management. The fixed asset turnover ratio improved from 0.93 in 2019 to a peak of 1.25 in 2021, then slightly declined to 1.12 in 2022 and recovered to 1.15 in 2023. Indicate enhanced efficiency in asset utilization. The total asset turnover ratio increased from 0.65 in 2019 to 0.79 in 2021. Decreased to 0.5 in 2022 and slightly improved to 0.59 in 2023. It's showing fluctuation in asset efficiency. The average collection period rose from 84 days in 2019 to 86 days in 2020. It improved to 63 days in 2021. Also, it's increased to 70 days in 2022 and slightly improved to 96 days in 2023. It indicates better receivable management despite some fluctuation. In conclusion, while Farm Fresh has seen variability in inventory turnover and total asset turnover, it has been achieved a relatively stable fixed asset turnover ratio and improved receivable management since 2021. Thank you.
Leverage ratio is a financial metric that compares the amount of debt incurred by a business entity against equity or assets. Generally, this ratio is able to measure a business' ability to repay new and existing loans. Based on calculation made, there are four types of leverage ratio. Firstly is debt to assets ratio. This ratio indicates the percentage of a company's total assets that are funded by liabilities. Secondly, debt to equity ratio. This ratio indicates how much of the company's operations are financed by debt versus equity. Similarly, the long-term debt to equity ratio. There's not much difference as this ratio indicates the reliability of a company's operation through long-term liabilities. Last but not least, we also can measure business ability to repay loans by times interest coverage ratio. This ratio commonly used by lenders, creditors, and investors to determine the riskiness of lending capital to a company. As provided by the chart, which shows the measurement of leverage ratio within 5 years. For 219, Farm Fresh recorded 23.5 for debt to asset, 40.9 for debt to equity, 28.2 for long-term debt to equity, and 149.6 for time interest coverage. For 220, Farm Fresh recorded an increment for all ratio. Debt to asset ratio increased to 37.2, debt to equity ratio increased to 81.2, long-term debt to equity ratio increased to 50.1, and time interest coverage recorded increment to 198.2. For 221, all ratio continues to increase except for long-term debt to equity, which it recorded decreased to 45.7%. Debt to asset ratio increased to 40%. Debt to equity ratio increased to 106.1. Time interest coverage increased to the 390.6. For 222, Farm Fresh recorded decrease in all ratio. Debt to asset decreased to 28.9, debt to equity ratio decreased to 48.1, long-term debt to equity ratio decreased to 39.3, time interest coverage ratio decreased to 7.69. Conversely, 2220 recorded decrease in all ratio except for time interest coverage, which it decreased for 5.55. Debt to asset ratio increased to 32.6. Debt to equity ratio increased to 54.9. Long-term debt to equity ratio increased to 39.8. We can see Farm Fresh goes through a fluctuating phase that may be caused by various factors.
In conclusion, Farm Fresh financial performance, particularly its liquidity and working capital management, has shown notable improvement over the analyzed period. The liquidity ratios, including the current and quick ratios, highlight the company's enhanced ability to meet short-term obligations, especially between 2021 and 2022, where there was a significant jump in both metrics. Although there was a slight decline in 2023, the company maintained a strong liquidity position compared to the earlier years of 2019 and 2020. Overall, despite minor setbacks in 2023, the company's financial health, particularly its liquidity and working capital management, is much stronger now compared to the start of the period in 2019. Thank you.